Welcome to another episode of The Intelligent Speculator, where our purpose is to provide insights into economic and market movements that have been successful in helping us grow our wealth. And now, let's hear from the hosts of our show, Jesse Sanders and Lathan Fritz.
Hey guys, I'm your co-host Jesse Sanders, and on today's show, Lathan and I are discussing the recent rise in stock prices that we've had over the last month, and why you have to look a bit deeper to understand the cause of why this bounce back has happened in the markets. So let's jump right in. Okay, so here's a question for you, Lathan. We're looking back a month ago. Dow Jones has reached major low. We're about March 23rd. I think it was about 18,500. Fast forward to today, March 5th. We're just over 24,000. So we've had increase in stock prices, but the baffling thing to me is unemployment claims over 30 million, and U.S. production, everything seems to be either on pause or has drastically slowed. So from my position, I don't understand the lack of correlation between those two. I would assume that stock prices should be going down when no one has jobs and production has stopped. Any thoughts?
Yeah, no. That is I would say if you're looking at from kind of like a logical perspective, that scenario seems completely baffling. But kind of we've talked about this before. Like I've said this statement that the market can be irrational longer than you can be Sullivan. So, to put that in perspective, like, yes, logically you should have been putting shorts on the market this entire time in the month of April, based on all the evidence and figures and stats that you just gave me. But you would have lost money significantly if that would have been the case. Now, do I think if you would have put a short on now and you could financially survive the month of April, that 12 months from now, do I think your short's going to pay off? Yeah, probably pretty well, if I had to guess. But I say all that because most of this kind of initial bottoming out has occurred because the Federal Reserve injected close to $6 trillion of stimulus money directly into the financial system, meaning they bought up treasury bonds, they bought up assets, they're buying corporate debt via ETFs. Like they literally took the snowball known as the U.S. economy and stocks that was just rushing down this hill toward just like an absolute collision, and they kind of just stopped it in its tracks momentarily.
And that's when you're talking the sale when it up from the 30,000 down to the 18, the rapid crash from last month.
Yes, yeah. So you at that point you had this thing just crashing down, and the Federal Reserve's like, oh my goodness, we have to pull out all stops. And it wasn't just the Federal Reserve. I mean, you had the United States federal government. He put in the $2.2 trillion relief bill, and they're literally part of that is just money going directly to people. It's what Federal Reserve Chairman Ben Bernanke once called helicopter money, where it was kind of like the hypothesis you could have if you needed to have emergency stimulus, you could just have helicopters fly over cities and drop money to people to spend and alleviate.
Instead, they just wired it directly to
Instead they just wired it directly to people, and that's a lot and not just to people, but even I think it was $350 billion that was basically grants to small businesses. So they get money, and everybody's encouraged to take it if you're a business owner, because as long as you use it for payroll and rent, it's a grant. You don't have to pay it back. And so they spent $350 billion on that. I think another $250 billion was passed last week. So right up, we're up to $600 billion in just free money to small businesses. You have each individual in America getting $1,200 per person, $500 per child. And really that is a classic definition of helicopter money. So you have all this kind of like helicopter money, going from the federal government. You have the Federal Reserve printing money, buying corporate bonds, because at the time nobody wanted to buy these corporations' debt. And the corporation, in order to survive, needed to raise funds to pay off the debt it already had and to pay its overhead and its employees and everything else. And for a moment now, the Federal Reserve, by coming in and buying all that up, it put kind of like a bottom into the market. And like I said, a momentary, a brief bottom. And it gave it kind of like a steam of where at first in March, you could say, selling was begetting selling. So, as more and more people sold, prices got lower, more people got worried about losing more of their net worth, more of their wealth. So they in turn sold again. And you had this cycle all the point until the Federal Reserve came in, the federal government came in and said, here's all this money. And, we're here to save you, as it were. And then pretty soon people are like, oh, maybe the bottom is here. And then when you found kind of like support and the stock market started creeping up, people are like, oh, maybe the worst is over. And so now you have kind of like investors who are starting to kind of like, slowly start putting money back in. And, to the point now where I think from the bottom of March to now, I think the stock market has actually had around a 70% recovery or something like that for the Dow Jones Industrial. But again, I think it's going to be it's going to be a small blimp recovery. I think we could be getting here into very, very big trouble in the next, 3 to 5 months.
And so you don't think the helicopter money that came out, none of that stuff's fueling the purchase of stocks. That's just going to Band-Aid to stop the bleeding for groceries and rent, right? You're saying investors are coming in. These are the hedge fund managers, the big businesses that are coming in to speculate and kind of do plays on the stock market. Was that what you'd attribute the raise in prices to?
Yeah, yes, exactly. So it's like, you had and quite frankly, the Federal Reserve, when they bail out people, they bail out the rich, right? The Federal Reserve, when they print money, it immediately goes into like actual like institutions and and financial assets. So things that the wealthier and wealthier companies control. So like what the federal government did, they just kind of stopped the bleeding for the consumer, like the average Main Street Joe and Jane. These basically like, we got to keep these people alive because we're already at 23% unemployment, and they definitely want to avoid any kind of significant bigger increases in unemployment. They want to avoid kind of like social unrest or violence, because if people start you can't get food, can't feed your family, pay your mortgage, people do desperate things. So basically that money was just like, we have a huge, not just a financial problem, we have a social and political problem where our political survival is on the line here. And so they're like, we're going to pass the largest bill we've ever passed in the history of not just the world, per capita. This is the largest relief bill that has been passed in the history of the world. And so that was more just kind of like your average Jane and Joe, just to keep them alive and afloat, as opposed to where the Federal Reserve was mostly buying kind of like into the corporate and giving a bottom to the stock market and financial assets. And so you had more investors that are looking at what the Federal Reserve is doing, saying, oh, I think things are getting better there now. But like, for the 23% unemployed who are getting a $1,200 check, they're not using that check to go buy stocks. Like even your person who might still have a job that gets their $1,200 check, they're looking at this like, will I have a job in a couple weeks or a couple months? And if I do, am I going to have a significantly reduced salary as a result of this pandemic? And right now they're not looking at investing in their future. They're looking at surviving. So they're going to be kind of looking at like, do I pay down debt? Do I just save this cash and sit on it to kind of like help, weather through and get through this situation? But, your average Main Street individual is not looking at the relief bill coming out of Washington and saying, I'm going to play in the stock market,
yeah,
especially since, we just saw, literally everybody was talking in January and early February. It's like best economy there ever was, like, stock market's hitting all-time highs. And then because of a virus out of China, at one point your net worth is down 40% in 3 weeks. Like, that doesn't put a lot of confidence that that's what you want to do with your $1,200 at a time like this. So, I think I think that is like a great question, something that we're going to have to follow closely as all these things play out.
Now you mentioned the bond buybacks. That's how a lot of these companies are raising. They're getting money. There weren't buyers in the market for them, so government steps in and buys these and gives them cash. What are they then doing with that cash? How would that have effect? How did the decision to buy these bonds? How did that play out? If it's not the individuals aren't buying and helping raising the prices, it's not they're buying, begetting buying. It's the buyback of these bonds. So how did that play out?
So basically, you had the Federal Reserve come in. Nobody wants these people's bonds because everything's risky. Nobody knows what's going on. Federal Reserve comes in, gives them cash. Now, a lot of these companies have stipulations to the point that they're no longer allowed to do like share buybacks with that cash. But by having the cash, it allows them to, one, not have to necessarily lay people off, not have to close down factories or equipment that they have, and not have to sell assets. Because those are the three things that people look at when buying a stock. Because if a company's already in trouble and they're like, we can't make our debt payments, what are they going to do? They either have to be like, well, what assets can we sell or who can we lay off? And if they start laying off people or selling assets, again, that's where it's like, if you're an investor and you're like, wow, this is looking bad, like they're going closer to bankrupt, right? And so as an investor, you're like, I need to get out because they might go bankrupt.
No one wants to be on the sinking ship.
Exactly. So while it didn't necessarily like directly buy shares, what it did was allow these companies to have cash on hand so that they can still maintain their, employment of most of their people. They can still, they don't have to sell their assets. They don't have to close down factories or machinery or assets that they own. They don't have to sell it. They get to keep it. And they have cash on hand to continue to make their debt payments. I mean, granted, they took on more debt as a result of this, but at least they have cash to kind of like for investors to feel like, oh, now they have enough cash on hand to weather the storm. They can pay their debt, they can make their debt payments. They don't have to sell assets. They can keep their people employed. So by keeping their people employed, they maintain market share. And so that's like the psychology behind the investor, where it's like, these companies aren't selling assets. They're not laying people off. They're not giving up market share, and they have cash in the bank to make their debt payments. We're good again. Even though, again, you might be like, are you really that good again? Or did you just, have like a failing corporation, have bad money go after, good money go after bad, and all you've done is extended their life a little bit longer. Yeah,
so it kind of just blew a bunch of air into the financial sheets of these companies, where it kept them from having a lot of potential red flags raised that investors would see and be like, oh man, okay, big sell-offs, big layoffs, I'm jumping ship. They
exactly.
Gave them a lot of access to cash to cover themselves a little bit.
Exactly. Yeah.
Well, last question I'll leave you with. The Fed, they came in, they put up this wall, and market is now going the other way. At what point would you anticipate seeing that next downshift and the sell-off happening again?
And again, I kind of look to history towards this, and it could be a little bit shorter, it could be a little bit longer, but history has a tendency to rhyme. And, kind of where we are at in the economic cycle of how much debt we have, and kind of like the deleveraging process that has to take place. If you look back in 1929, we were in a very similar situation. We had this, lots of very, very significant debt in the corporate world, personal level, and government debt. That had fueled the American economy in the 1920s. And then in 1929, as we all know, you had that first crash in October. And, the market was down at one point by 40%. Well, just like today, the Federal Reserve stepped in, they cut interest rates to zero. And they also went on a massive stimulus printing spree where they were putting money into the system. And which gave, again, kind of like same concepts, everything we just discussed, gave brief support to the market, to the point the market, the Dow Jones recovered to only about 20% below where it was in October, of 1929, and that recovery happened from November 1929 all the way to March 1930. And so it was about 5 months of the market, having what they call a bear market rally, before eventually it would sell off again in March 1930, and then it would go down for the next 2.5 years until it bottomed out at an 80% loss of its highs from 1929. And so I anticipate kind of like a similar scenario. We have this bear market rally over the next 3 to 5 months, and just kind of like the problems that we had in 1930 that we have now, the Federal Reserve, when we have these bad companies that just got more debt and we gave them a little bit more runway, when more of them start defaulting, more of them going into bankruptcy. And the fact is, this pandemic has kind of accelerated a lot of this, because before, people were counting on making their debt payments and paying the interest on their debt by growing their companies, increasing their revenues. And this pandemic, like how many companies are going to be increasing their revenues over the next 6 to 12 months? Very, very few, outside of your few niches in technology like Zoom and Amazon. But most companies, they're going to contract. They're not going to be able to make all these debt payments that the Federal Reserve just bought back. And at that point, the Federal Reserve is going to have to ask themselves, like, we can't do this massive thing again, because their ultimate goal is they have to create price stability for the currency. So they can't let massive inflation. You can't let a massive inflation come in.
Yep, and they can't just keep repeating the cycle of smashing the snowball over and over again.
Yeah, exactly. Eventually, you have to let the snowball go. And every central bank has come to that conclusion. Like you help as much as you can, but at some point, it's beyond you. Mm-hmm. And so, as these kind of like bankruptcies increase and people can't make payments on their debt, and we basically just extended the life of a lot of these like bad companies that probably a lot of them even should have probably gone bankrupt back in 2008, 2009. You're going to kind of like start seeing acceleration of these bankruptcies. And at that point, the Federal Reserve is going to be like, we'll have to be very careful who we pick and choose to save.
Yep.
And so they're gonna let people go. And at that point, if the Federal Reserve isn't coming in and buying additional debt and bonds, those investors are gonna be like, oh my goodness, like now they're selling assets, now they're laying people off, now they're losing market share. And, then that's when you have your next big wave of the sell-off, which, if I had to guess, is going to be somewhere 3 to 5 months down the road. And kind of a final thought that even think about it is, I'm not necessarily alone in this. Like, Warren Buffett over the weekend, the Financial Times had the main article was he's liquidating all of his airline stocks. And he said on May 2nd during their shareholder meeting, he's like, I wouldn't say, I'm not recommending necessarily that anybody buy stocks in the next weeks, months, or possibly year. And I think that says a lot when Warren Buffett has kind of been very good at, he's not perfectly at timing the market. No one is, but he's been very good at knowing like when everybody's selling, kind of coming in and buying. And when everybody's buying, kind of laying back and selling or getting out. And the fact that he was willing to take such huge loss on selling those airline stocks tells me two things. One, like if I had to guess, the airlines are in a world of hurt over the next couple of years. We might not see any of our familiar brands here in the next year or two. They'll probably be restructured and rebranded and renamed. But I also think that that spoke volumes on his perspective of where stocks in general are going. And if I had to guess from his tone, he doesn't think they're going up anytime soon. And we probably have a lot more pain ahead of us in the equity markets before we finally hit a true bottom. And then we can start, before it kind of starts going up again.
Well, man, on that note, hope you have a great week.
Yeah, with that being said, there's always opportunities in times like so.
No, but yeah, seriously,
very, very good opportunities.
It makes a lot of sense. Yeah, it makes a lot of sense, and I'm hoping, man, maybe on next call get more into that both on the airlines and kind of on Warren Buffett and his moves. I've got some other questions I want to get into. This is all the time we have for today. So, I do. Thanks, and have a great rest of the week, and look forward to talking again here soon.
Yeah, sounds good, brother. Talk then.
Thank you for listening to this interview with Lathan Fritz and Jesse Sanders. We hope to see you next time, and remember to like and follow The Intelligent Speculator on Facebook, Twitter, and Instagram, where we are posting insightful nuggets of economic and market movements. And if you would like to get exclusive information, feel free to join the Intelligent Speculator Facebook group. Good day.